Tesco is the United Kingdom's leading supermarket chain and has maintained its market dominance since surpassing its competitors in 1995. The group comprises of several subsidiaries including Booker Group, dunnhumby, One Stop, Tesco Mobile and Tesco Bank, though this has partially been sold to Barclays Bank. As a result of the Tesco supermarket chain alongside the subsidiaries, Tesco had a group revenue of 68.2 billion from group sales of 61.5 billion in 2024. This presentation will provide you a financial analysis from the 2023 to 2024 period and outline a long-range and short-range budgeting exercise. This analysis encompasses a review of Tesco's financial performance for the years 2023 and 2024, with benchmarking against Sainsbury's, Tesco's competitor. The evaluation is structured around 5 components: liquidity, efficiency, productivity, financial leverage, and shareholder returns. Each aspect is assessed through financial ratios, which provide critical insight into Tesco's short-term solvency, operational efficiency, asset utilization, and risk profile. Tesco's liquidity ratios have declined from 2023 to 2024. The working capital ratio dropped from 26% to 22%, the current ratio from 70% to 66%, and the quick ratio from 55% to 46%. By comparison, Sainsbury's reported 30%, 66%, and 49% respectively in 2024. These changes are primarily due to the partial sale of Tesco Bank to Barclays, reducing the assets that Tesco owns. Efficiency ratios improved notably in 2024. The gross profit margin increased from 5.1% to 7.1%, the operating margin from 2.1% to 4.1%, and a net profit margin from 1.1% to 1.8%. Productivity measures reflect similar trends, with inventory turnover adjusting from 24.5% to 23.8%, fixed assets turnover increasing from 2.9% to 3%, and total assets turnover rising from 1.4% to 1.7%. Tesco became more efficient in managing its expenses due to reduced expenses from Tesco Bank, as well as the reduced assets in regards to the productivity measures. This is evident in the increase in key profitability margins. The debt ratio remained constant at 72%, while the debt-to-equity ratio improved from 275% to 242% in 2024, thereby reducing risk. Additionally, the return on assets doubled from 1.5% to 3%, and return on equity increased from 6% to 10.2%, reflecting improved profitability. Shareholder metrics indicate a slight decline in dividend yield from 3.75% to 3.39%, while the dividend payout ratio remains stable at approximately 52%. Now looking at the future budgeting exercise, the long-range budget details a 5-year strategic objectives plan and budget of 7 billion aimed at achieving consistent sales growth, reinforcing Tesco's value proposition, and expanding its online market presence. Capital investments are allocated towards inventories, research and development, and property, plant and equipment, with approximately 75% of funding sourced from debt. The short-range budget addresses immediate operational concerns raised in the financial analysis, specifically improving liquidity and reducing short-term debt, with a dedicated budget of 850 million allocated for inventory optimization, refinancing and debt repayment initiatives. Financial analysis of the budgeting exercise. Liquidity. The SRB will boost Tesco's short-term financial health, improving key liquidity ratios like the working capital and quick ratio, but this will slightly falter due to increased assets in 2029. Efficiency is expected to see increased efficiency across the board, with the gross profit margin reaching 9.5% and the operating profit margin hitting 5.5% by 2029. Productivity. The LRB's investment will lead to better use of assets with improvement in inventory turnover. Debt. Tesco's risk profile will improve initially, with the debt ratio decreasing to 70% in 2025. However, it will rise slightly to 72% by 2029 due to increased borrowing for assets. Shareholder returns. Shareholders can expect a slight increase in dividend yield in the short term, stabilizing at 3.4% by 2029. Overall, the LRB and SRB are projected to strengthen Tesco's financial position, leading to improved efficiency, profitability, and asset utilization, ensuring a positive outlook for the future of Tesco. In conclusion, while Tesco has experienced some challenges in liquidity, primarily due to the sale of Tesco Bank, the overall financial performance has improved significantly, and Tesco in 2024 look strong, in particular their efficiency. The LRB and SRB exercises were designed to further enhance Tesco's market position and financial stability. Continuous monitoring of key ratios, especially liquidity, leverage, and return measures, will be essential as these strategies are implemented. The key takeaway from developing this report is not to make financial and economic assumptions, and that financial ratios are a good tool to review financial situation of a company.